Tesla is unprofitable. It's burning cash through record levels to the point where it may actually run out of reserves by the end of next year in 2018. Tesla is swimming in a mountain of debt that poses severe leverage risk for the company. Tesla's shares are fundamentally overvalued by just about any measure imaginable. And for all of those reasons, Tesla's equity is worthless. This is what some people like Jim Chanos, the famous short-selling hedge fund manager, is saying, as well as a lot of deep pockets out there that are short Tesla shares. Tesla is one of the most heavily shorted names out of all large cap stocks out there. And for good reason. There's a lot of really interesting things that are going on with Tesla, almost none of which are actually translating into the financial statements of the company. So in this video, let's take a look at all 5 of those items that a lot of pessimists out there are saying regarding Tesla's shares. First is their profitability. If you take a look at their income statement, since 2013, it's true, Tesla has been fundamentally unprofitable. In 2013, they generated a net loss on a non-GAAP basis of $18 million. The following year, in 2014, minus $136 million. In 2015, minus $493 million. In 2016, minus $554 million. And over the last 4 quarters so far in 2017, including the 4th quarter of 2016, they've lost a record $1.4 billion. So on the surface, this is actually true. Tesla is a cash hemorrhaging business. But what's the problem with net income on the income statement? The main problem with using net income to analyze companies like Tesla is that net income is an accounting figure, meaning it uses the system of accounting called accrual accounting, which means that income and expenses are recorded as they are accrued. This is in contrast to cash accounting, which takes a look at what cash income is coming in versus cash that's leaving the business. So one way that we can adjust this number, just to take a look at Tesla, because Tesla, again, is a capital-intensive business. We know that they're setting up gigafactories in everywhere, really. Two main gigafactories coming up in the United States, as well as the significant ramp costs surrounding the Model 3 production. So there's a lot of capital-intensive activities that Tesla's going through. So any industrial company that has this type of capital-intensive activities, we need to take a look at what's going on with depreciation. So the way to adjust earnings per share or net income is to add back depreciation. Because remember, depreciation is a non-cash expense, which means that it's an expense that's recorded on the income statement, which ultimately affects net income, the numbers that I just showed you. But it's not actually a cash expense, meaning it's not cash that's actually leaving Tesla's bank account. So if we were to take net income and simply add back depreciation, that paints a completely different story. In 2013, instead of a loss, Tesla actually earned $103 million of adjusted cash flow. In 2014, that number was $165 million. In 2015, it was only $2 million, but it was still in the positive territory. In 2016, they generated $460 million of adjusted cash flow. And in the last 4 quarters, they've generated $127 million of adjusted cash flow. Now, these aren't earth-shattering numbers. We're still talking about the hundreds of millions for a stock that's worth $50 billion in market cap. But you can see that if we were to just make this simple analytic adjustment, and this is an adjustment that a lot of financial analysts make out there, to calculate a company's true operating income on a cash basis, not on an accrual basis, it tells you a very different story. Tesla is not actually fundamentally unprofitable. If you simply add back that non-cash expense depreciation, then it's actually very profitable. And in fact, if you look at the growth rate of that profitability, it's exceeded a clip of 37% on an annualized basis. So this tells us a very different picture. Tesla may look unprofitable on the surface if you just look at the income statement, but this is a fundamental flaw in any financial analysis. You can't just look at earnings per share. You have to also look at what's going on with cash flows. And one of the ultimate and most simplest ways to calculate cash flow is to take net income and simply add back depreciation expense. And this is what we just did. The next argument that the bears are making on Tesla is that they're burning cash at record levels, to the point where they're actually going to run out of cash and they're only going to have to do another capital raise of more equity and more debt to just continue going. Now, this is a real problem. I definitely agree with this. Tesla has had a number of equity offerings and debt offerings over the past several years just to keep the company going. But the problem with this analysis and just relying on that simple fact alone to make a pessimistic case to bet against the company is to ask the question, why are they raising this money? If the company is raising money just because it needs to pay its bills, then that's a real problem. But what people don't understand is there's a difference between capital expenditures and operating expenditures. Operating expenditures are things like paying your salaries, paying your bills to keep the lights on, making minimum payments on your debt. Every single thing that it takes on a day-to-day basis to fund your operations, those are operating expenses. Capital expenditures are things that you invest in for your company to grow. Now, there's also two types of capital expenditures. One is growth CapEx, and the other is maintenance CapEx. Maintenance CapEx is used to service your existing fixed assets to keep them running. Growth CapEx is investing in new plant, new property, new equipment to grow its business in the future. And of course, this is obvious that Tesla is spending billions of dollars in building gigafactories in order to achieve the Model 3 run rate of 10,000 cars per week, as stated by Elon Musk. So my question is, since when have financial markets penalized a company for investing in growth CapEx? It hasn't. So as long as the financial markets are reassured that this money that Tesla is raising is to increase its production capacity of the Model 3, and then of course after that we have the Tesla semi-trucks also coming. These are all growth opportunities that Tesla is investing in. If we take a step back and just look at what I just said previously, which is that Tesla is actually profitable if you add back depreciation expense, Tesla really could just be like, okay, we're not going to deal with the Model 3, we're not going to deal with the semi-truck, and we're not going to deal with anything else. We're just going to be a Model S and a Model X company. They would be profitable because they wouldn't have this huge amount of growth CapEx and all of the working capital needs to be able to fund all this and thereby require all these debt and equity financing. But they're not. They're taking it a step further. They're taking it 3 steps further and trying to scale to the point where they can become a mass market company. There's never been a time in the history, at least that I know of financial markets, where equity and debt, capital holders penalize a company for investing in growth CapEx. So the only time that Tesla is actually going to run into real issues is if they actually have difficulty in selling their products. That's when you need to start being worried. But if you just look at cash burn of the company and look at the fact that they've had multiple debt and equity offerings, that is not the only reason why you should be pessimistic on Tesla. Tesla is investing in growth CapEx. As long as that continues and as long as there's real evidence of demand for these products, the financial markets are just going to keep on giving more and more money to the company every time it needs to do a raise. And also, while the cash burn is real, the growth is also real. So we've seen that all this investment in growth CapEx has led to, as I said earlier, 37% annualized adjusted cash flow growth, a 45% annualized EBITDA growth, and 52% annualized revenue growth. So although there's cash burn, the fact is that the growth CapEx that's being invested in the company which Tesla relies heavily on the financial markets to fund, is actually translating into real growth. So there's evidence that all this growth spending that the company's been doing is in fact translating into real growth that's flowing into the top line. The third argument that a lot of bears are saying on Tesla is that they're swimming in debt. And it's true. Any simple look at the balance sheet shows long-term debt has grown, and not just grown, but it's grown exponentially. So this is also a real problem. But if you look at other balance sheet ratios over the same time period, long-term debt is growing exponentially, and yet the assets to equity ratio, which also measures balance sheet leverage, has actually remained the same. So there's actually not that big of an issue going on here, because even though leverage has gone up, the fact is that Tesla has grown its book value of equity at the same time, so that the assets to equity ratio has actually been flat over the past 5 years. Also, another way to look at leverage is to adjust leverage, meaning long-term debt, by subtracting out the cash that it has on the balance sheet and dividing it by total capital. This is what we call the net debt to total capital ratio. And if you look at this, the number is only about 41%. So this is very, very reasonable if you compare it to the Russell 1000 Growth Index, which is the appropriate benchmark to compare Tesla against, which stands at about 40% in terms of net debt to total capital. So this is a very, very reasonable leverage ratio, in my opinion. And the fact that, although long-term debt has exponentially grown and assets to equity have been flat, and adjusting the net debt minus cash relative to total capital is actually pretty reasonable compared to similar growth companies, there's not a whole lot of evidence that suggests that leverage is a major problem for Tesla. In fact, I think they could raise even more debt in 2018 if they need another debt, if they do need another, cash raise. But that's not to say that there's no risk at all. Of course, every company that has debt on the balance sheet, and especially long-term debt on the balance sheet, of which a large portion comes due all at once, that is a pretty interesting liquidity question. But again, this is all for one reason and one reason alone, and that's to achieve a run rate of 10,000 Model 3 cars. So again, you have to look at debt relative to what the debt is being used for. Is it being used to simply stay alive, or is it actually being used to grow? In Tesla's case, we know through fact that revenues, EBITDA, and adjusted cash flow are growing exponentially. And so if you have exponential growth in long-term debt alongside growth in revenues, that actually doesn't raise a red flag at all for most financial analysts, especially when you combine it with the fact that we have a steady assets to equity ratio and a very reasonable net debt to total capital ratio. The fourth argument that a lot of people who are betting against Tesla make is that the shares are just simply overvalued. So let's take a look at that. It's true. If you take a look at PE, price to cash flow, EV to EBITDA, these are all standard valuation metrics, and they're perfectly great instruments to use to analyze companies and to pit them side by side. It's true, the PE is negative 40, again, because we know that the accounting net income is negative for Tesla. Price to cash flow, even if we use the adjusted number that I showed you, it's still trading at 325 times its annual cash flow. EV to EBITDA, similar thing, 123 times EBITDA. These are astronomical. There's no way around it. There's no way to justify that. It's absolutely true. But if we take a look at another set of valuation ratios, it tells you a completely different thing. Price to sales, price to book value, and even price to tangible book are all below the tech group average. And I took a couple of tech companies that you can compare Tesla against, mainly because Tesla shares correlate generally with this group of stocks. In that case, these three ratios are perfectly average and in line with the group. In fact, in some cases, Tesla is cheaper than some of the other companies out there. And it's also lower than the average of that group. So what I'm trying to say here is who's to say that PE or EV/EBITDA are superior to price to tangible book or price to sales? They're not. In fact, all the academic studies show that all of these ratios have predictive power and have, pretty good use when it comes to financial analysis and looking at value. So some valuation ratios are showing astronomical figures for Tesla, and others are showing not so astronomical views of Tesla. So the question is, well, which ones do you use? The question is, you should use all of them, or the answer is you should use all of them. All of them should be used in conjunction with one another. So the problem that I see with a lot of short sellers out there and a lot of people betting against Tesla is that they cherry pick and they point to these specific ratios that are really, really high. And they've got a point. They're not lying, but they're also not telling you the entire truth. Price to book value is a great measure. Price to tangible book is even a better measure. And those are saying that Tesla is a perfectly normal company. Secondly, it's also important to look at valuation ratios relative to growth. Remember, the financial markets rewards companies that have high growth rates. So companies that have high growth rates warrant higher price multiples. Companies that have low growth rates warrant lower growth multiples. This is a very basic fact, a very basic principle, I should say. So if we adjust the price to, let's take the price to sales ratio as an example. If we adjust price to sales by the growth rate in sales, then it actually shows that Tesla is at the very bottom of the sample group that we selected. Now, again, I'm picking out this list of stocks, but again, the only reason why I'm doing this is because Tesla is typically grouped with companies like Netflix, like Microsoft, like Amazon. Even though Tesla is a very capital-intensive business, Microsoft and Netflix aren't necessarily capital-intensive, but companies like Amazon are. So if you take a look at price to sales divided by the historical growth in sales, or if you take a look at price to sales divided by the estimated growth in sales over the next 2 years, then it tells you that Tesla is actually the cheapest stock of the entire group. So again, I think that if you use valuation ratios, and they're great tools to understand value and understand what your return on investment might be, you need to take a look at it relative to growth. And we know Tesla has been growing by 50% on revenue growth. Of course, 50% year in, year out is not sustainable for any company, but we know that it's growing at a fast clip, at least over the next several years, as the Model 3 ramps up, as the Tesla Semi ramps up, as Tesla's other products ramp up, like the solar roof product and others. We know that Tesla is growing. So when you take a look at the valuation ratios, even though they're very high, you need to adjust it by growth, and that'll give you a much better apples to apples comparison with other stocks in the universe that you're comparing against. And so the fifth and final point that a lot of people betting against Tesla, Jim Chanos, others out there, is that Tesla's equity is worthless. Now, this was a pretty startling claim. Jim Chanos was on CNBC recently, about 2 weeks ago in December 2017, and he told Kelly Evans, one of the anchors on CNBC, that he thinks that Tesla shares are worthless. The equity is worthless. And this was startling. I almost fell off my chair. A lot of short sellers, they short stocks because they are very, very bearish on them. But very few people actually are making the claim that the company is completely worthless, zero. So I thought, okay, let's take a look. Let's take a look at Jim Chanos's thesis here. A company can only be worthless, and this is just me. I know I actually have a great respect for Jim Chanos. I actually like to listen to his opinions. This is not an attack on him or his intelligence. He's made a lot of money, a lot more than I have, and he's made some really, really great bets, like, for example, betting against Enron. But I think what Mr. Chanos needs to look at is book value of equity as a starting point, as a very, very basic starting point. So when is a company worthless? Very, very simply, when its liabilities exceed its assets, right? If your assets or your debt is greater than everything that you have, that is by definition bankruptcy. That is insolvency. But we know that that's not the case. So if we take a look at book value of equity, right, on the balance sheet, the value of the common equity, it's actually been growing, and not just growing, but exponentially. Now, Mr. Chanos may have a point, right? If he actually believes that the company is worthless in the future, there needs to be some evidence of that. We would need to see the book value or shareholders' equity on the balance sheet at least declining at a rapid rate. So that way you can, extrapolate that and say, okay, at some point in the future, this thing is actually going to go negative. But it's actually working against what Jim Chanos is saying. Book value in 2013 was at $667 million. The following year, it grew to $912 million. In 2015, it grew to $1.1 billion. 2016, that number was $5.5 billion. And in the most recently reported quarter, Q3 of 2017, that number was $5.7 billion. So there's no evidence at all that book value of equity is actually going down. In fact, it's going up exponentially. So there's really not much evidence to suggest that, the company is actually worthless. So in summary, I think what needs to happen is that you need to look at financial ratios and adjust them and look at them relative to other stocks that are the peers of the company that you're looking at. And ultimately, it's actually very difficult. Everything that I just told you right now is just straight out of the financial statements and creating these ratios, adjusting them, looking at averages, looking at compared to peers. But this is all stuff that you can do in a spreadsheet, okay? Tesla is working in an industry that is a game-changing industry. In fact, a lot of what they're doing doesn't even exist yet. The industry doesn't exist. We have Tesla cars. Of course, cars are a 100-year-old industry. But there's another technology that Tesla is developing that's worth untold amounts of money, which is autonomous driving. Now, we know Google is working on autonomous driving. We know GM is working on it. We know Volvo is working on it. And we also know Tesla is working on it. So it's not like Tesla is the only one working on this technology, but we know for almost with certainty that autonomous driving is the future. So Tesla is a leader. Even if it's not the leader, it is a leader in an industry that hasn't even been born yet. So valuation ratios are great to look at. They're fun to look at. I don't think they're necessarily a very, very strong indication of a company like Tesla that's working in an uncharted and undiscovered industry. I do agree that we need to keep an eye on the liquidity of the company. We need to make sure that long-term debt doesn't get too outsized relative to total capital. And most importantly, we need to make sure that revenues are continuing to go up. So far, we haven't had any evidence of revenue slowdown happening. So as long as Tesla is able to work through the production ramp up of the Model 3 cars and thereafter the Tesla semi-trucks, I think there's I think it's actually more risky to be betting against Tesla shares than to be long Tesla shares. And that's it.